I'm Charlotte McLeod with investingnews.com, and here today with me is Adrian Day, president of Adrian Day Asset Management. Thank you so much for being here.
Good to see you again, Charlotte.
Yes, good to catch up with you. It hasn't been very long, but so much has happened. And today we're here at PDAC. We've made it to the afternoon of the second day. So I think I can ask you how it's been feeling on the show floor. What is sentiment like? What have you been seeing and hearing?
Yeah, well, of course, as with a lot of people, when you come to PDAC, you're full of meetings, and so I haven't really been walking the floor too much. I mean, the audience is good. I mean, yesterday it wasn't jammed, as it has been sometimes in the past, which is, to me, an interesting tell. Sometimes you have to really push your way through to get anywhere. But it's certainly full and certainly more upbeat. I think the juniors are particularly upbeat. They've been able to raise money. People are well cashed up, and they're having conversations with seniors, which may or may not lead anywhere. Of course, you and I know that. It always makes me amused when a company says, "Oh, we signed 3 confidential agreements." Well, yeah. It doesn't mean anyone's going to buy you. It just means they want to look. But the mood is definitely upbeat.
Well, thank you for that context. I've been stuck here, so I really don't know. So I'm going to have to make my way down to the show floor tomorrow, I think. Let's talk about what the companies are doing right now. You're mentioning before we turn the camera on, it could be interesting to talk about the M&A in the sector and what the big companies are doing. So tell me your thoughts.
Yeah, so until recently, I think it's, and even now, I think it's true to say that for most large companies, and I'm talking about, the large 10 or 15 companies, when they look at M&A, they are not looking to buy something at the cheapest price they can get it. They are wanting to let the junior advance it, get the permits, get the social license, get all of that stuff done, and then they'll take it over when it's right for them, when they have the cash, when it fits into their pipeline, right? And they didn't mind overpaying a bit in order to do that. But I sense a shift in the last few months that prices have moved so dramatically that companies are saying, if we're going to buy that, then the sooner we buy it, the better, before the price moves up too much and before someone else comes in to take it over. I mean, Ferran is a good example where everybody assumed Agnico would buy it. But then Eldorado came in, and, now for Agnico, I'm just speculating now, but now for Agnico to pay a premium over Eldorado arguably would just be too expensive. It wouldn't be a good acquisition at that point. So I think companies, again, when you say, yeah, this is definitely going to be ours one day, I think they're going to move quicker. Now, of course, there's other projects where they're early stage and the company, and again, I just mentioned Agnico, so mention them again, where Agnico may take a 9% position, they've got a seat at the table, but it's still so early that they're just looking to see how it advances. So that's a different thing. I'm talking about where a company says that's going to be ours one day.
So there's a sense of some urgency that's developing.
I think definitely, I would say more urgency.
Is there a danger that these miners repeat the mistakes of the last bull market when they overpaid, etc.?
That's an excellent question. What a segue. We're not there yet by any means. In my view, we're not there yet. I mean, even if you look at all of the acquisitions that have been done, I can't think of a single one where I scratched my head and said, what on earth are they thinking? Maybe they paid a little more than I thought they would. Maybe it's in a jurisdiction. They're in Chile, now they're in Kazakhstan, okay. But the acquisitions, for the most part, have been valid, in my view. Now, will there come a day? Human nature is human nature. And there will come a point, and I don't think this time around it'll come from the companies. I think this time around it will come from big shareholders saying, why have you got $2 billion cash on your balance sheet? Do something with it. Buy something. Here's something you can buy. Here's something you can buy. And I think there'll be pressure from large institutional shareholders for companies to do something. So, but we're not there yet.
Okay, that is reassuring to hear that we're not there yet. And while we're on the topic of M&A, so we've been seeing, I think, a lot of deals at the large end of the spectrum in the mining sector. And one of the questions I think people have is it going to move further down the food chain and when? Any thoughts on that?
Yeah, I mean, we've seen a few in the mid-tiers, like, or whatever you want to call them, things like Equinox Bank, Calibre, and before that, B2 buying,
What's the one?
I've forgotten the name now. Now the company doesn't exist. I've forgotten the name, but Goose Bay, buying
yeah.
Goose Bay. But we've seen, I mean, Equinox Calibre would be a good example of that. I think we're going to see more of that. But, with the early stage, with the exploration companies, this goes back to what we were talking about at the beginning. With the exploration companies, sometimes they haven't actually developed a project yet. And a senior company, even an intermediate company, is not really going to want to spend $1 billion, $2 billion to buy something that hasn't been defined yet. So that will come, no question. But I think companies have to have a defined resource before someone else wants to buy them. Typically, Great Bear was an exception, of course.
Always an exception.
Always
to,
an exception
to the rule. I think that gives us a nice idea of what's going on in terms of M&A activity in the mining sector. Maybe we take a look at what's going on with the gold price right now. We are catching up on our last conversation, which was at the end of January in Vancouver. And that was a very exciting time for gold as well as silver prices. We had the big run up, and very, very soon after we spoke, we had a big correction. So what's your take on that? Was that something that was just necessary given how quickly the price moved?
Yeah, I think the correction in end of January, beginning of February was simply a reaction to how fast the gold and silver price had moved. I mean, as you say, if you look at the chart, I mean, they moved almost exponential in January and then just gave back some of that. To me, what the most interesting thing, particularly about the gold price, I would distinguish a little bit between gold and silver at this point, but particularly the gold price, was frankly how quickly it started to come back. And that, to me, points to the fact that there's just an awful lot of, increasing people who want to buy gold and are just waiting for a correction. Yeah, I mean, it's interesting to me, people who didn't buy 2000 and didn't buy 24 and didn't buy at 3, waiting for the pullback, they're happy to buy at 4,400 because it's pulled back, but they could have bought a year ago. So yeah, I mean, I think that just points to the fact that there's a lot of people on the sidelines, ready to buy. And of course we had, a few geopolitical events, since then.
Yeah, which we will cover. I have one follow-up
Okay.
question before we go there. If we look back historically, when we get to this stage in a gold bull market, is this the type of price activity that we tend to see where the price moves higher and it pulls back, but the pullback doesn't last as long? Is that typical?
Well, no, that's interesting. That's
Okay.
a really good question because you see that, I would say you see that in bull markets, reasonably frequently. But what we haven't seen in this bull market yet is what we saw in the 2001, 2011 bull market, or 2001, 2008, if you want to, put it there, or the 1970s bull market, which is a significant, genuine, real correction. In 1974, as you won't remember, but I remember, we had a 50% correction in gold. I mean, from almost virtually $200 to $100, virtually 100% correction. 2006, we had, I'm going from memory now, but I would think that was about 30% correction in the gold price, which means the stocks fell a lot more. We haven't seen anything, like that yet. And I think the reason we haven't seen that is because you've got significant buyers, major buyers, primarily the central banks since 2020, 2022, of course, and then more recently Tether. You've got two big buyers who are largely price agnostic or price insensitive. So if Tether sells, 10 million gold stable coins, they need, I don't know how much gold is each stable coin is backed by. I just don't know. So excuse my ignorance on this. I'm not a crypto sort of person. But if they sell 10 million gold-backed stable coins, they need to buy 10 million ounces of gold, and they need to buy it right away. They don't need to say, well, let's wait for a pullback, let's see if we can buy it cheaper in a few months' time. So they're price agnostic, and the central banks are largely price agnostic because they're not looking at putting reserves on their balance sheet to make a profit. And so I think that's what is meaningfully different, significantly different between this bull market and the previous two that I mentioned. The buyers are price agnostic largely, the major buyers. So I've forgotten what the question was, but that was the answer.
Yeah, we were talking about pullbacks and how this...
Yeah. So, I mean, will we see a significant pullback at some point? Maybe. I don't know. The thing with the central banks, obviously the central bank buying has slowed from the peak 2 years ago. The central bank allocation to the dollar, the dollar as a percent of central bank foreign reserves, global central bank foreign reserves in aggregate, we talked about this before, but in the year 2000, it was 78%. And it's been declining ever since then. 5 years ago, it was 65%. So this predated the current U.S. administration, and it will postdate the current U.S. administration. It's a long-term trend where they want to diversify away from the dollar, diversify away from a single asset, an asset of a profligate government, a government which wants to weaponize its dominance. So they have reasons to diminish their holdings. And when they sell dollars, most of the proceeds then go into gold. Some goes into silver. Russia and Saudi Arabia, I think, are the two central banks with silver. Some goes into the Japanese yen. Even the euro is not getting big pickups from the sale of the dollar. It's primarily going into gold. So when people say gold in central bank reserves, I always answer with the dollar, but I want to make it clear when you sell the dollar, you're buying gold. So the question is, they're now at about 48%. That's my calculation based on various numbers. So is 48% still too much? Well, I would say if you're genuinely worried about the profligacy of the U.S. government and you're genuinely worried about the weaponization of the dollar, I would say 48% is too much. Now, if you're Germany or France, maybe, or Sweden, maybe you say, okay, we're comfortable. The U.S. isn't going to come after us. But so at what point? So it's natural that it slows as the percentage goes down. It's natural that it slows, but I don't think we've seen the end of that by any means.
So I know nobody likes to say this time is different, but really it does sound like this bull market in gold has different attributes, and it could play out differently.
There are different attributes. Not this time is different, but there are different attributes. Well said.
Yes, a sneaky way of saying it. I think that sets the stage for us to talk about what's going on with gold in terms of current events. During our last conversation, we talked about two new additional gold price drivers. You brought up chaos and uncertainty related to the Trump administration. You brought up Tether, which we were just talking about right now. And certainly, I think we've seen the uncertainty angle intensify this past weekend with conflict breaking out in the Middle East. So this is developing. We're talking on Monday, March 2nd, for everybody's context. Probably too early to say much, but how do you see that impacting gold?
Yeah, well, I think last time, if I remember, I said it was general chaos and uncertainty rather than specifically, I don't know if Venezuela had happened, but specifically, Ukraine or Gaza or one thing or another. Geopolitical events, I don't know if we talked about it last time, but geopolitical events generally, if you look back over 50 years since the Iran again, right? Since the Iran hostage situation in 1979, when they took over the U.S. Embassy. Again, you don't remember, but I actually remember. And then, of course, poor Jimmy Carter sent the Marines in to rescue them, and the mission failed. But since then, geopolitical events typically have a very short-lived spike. Very short-lived spike. And the classic case would be the Russian invasion of Ukraine, where the gold price moved up meaningfully in like the 2, 3, 4 weeks ahead as Russia was massing troops on the border and all the speculation was about a war. But the day those tanks crossed the border, gold peaked, and within 3 weeks, it was back to where it was before it started. And just look at the current situation. This is, now again, as you said, we're talking on early Monday afternoon. I've had lunch and a meeting, so when I left my room, right, so we're talking Monday morning, the interesting thing is that over the last 7 days, as we've had all this saber rattling, gold moved up $300. Today, which is the first day after the, it's not an invasion, after the bombing, gold is up 15. And I think that just goes to illustrate, now I may be proven wrong tomorrow, but I think that goes to illustrate what I've been saying. That geopolitical events tend to have a spike, but they tend to move up ahead of the event, and the event is often the peak. So I don't think that that's going to be the big driver of gold. And frankly, I'm happy about that, because I don't think any of us really want to be profiting over, bloodshed and human misery. It's monetary factors that are driving gold. That's what's fundamentally driving gold. Monetary factors, lack of trust in governments, and particularly lack of trust in fiat currencies. And that trust has been completely broken with so many currencies. People just don't trust currencies anymore.
I think that is becoming more and more clear. And another question that unites the chaos with Tether, I was seeing, I don't know if you saw this, over the weekend, I was seeing online people looking at the price of the Tether gold stablecoin, because it trades 24/7, trying to use it as a way to project what happens to gold on Monday. So I was curious, does that, I know you said you don't really follow crypto or know too much about it, but does that make sense to you?
Well, I think that makes sense. I must admit I wasn't doing that because I was at the show.
Yeah.
But yeah, no, that absolutely makes sense. Yeah. And of course, gold opened in Asia last night, so I was looking at it last night, obviously, and preparing my trades, for this morning based on what was happening overseas.
Yeah, it's quite interesting. I'll have to also keep an eye and see how they track in the future. As we can see, there's so many drivers behind gold right now. I think we talked a lot about what was going on at the Fed last time. I'm sure that continues to develop. One thing I'm not sure if we spoke about, I think we talked about the new Fed chair nomination, but there's increasing division within the Fed. And I wondered if you have any comments on that.
Yeah, no, that's really interesting to me, because the Fed traditionally has been very collegiate body, right? So they have their discussions, some disagree, there's a debate, they have their discussions, but normally, most of the time, when the chairman says, okay, we'll raise rates by a quarter, we'll drop rates by a quarter, we'll keep them stable, everybody goes, there won't be dissents. Dissents are relatively unusual. Now, we've seen more dissents in the last 6 months than we typically do, and that's because of the Trump appointees or the people wanting to be the next Fed chairman who, wanting to dissent and say, we want lower rates, hoping to impress President Trump and get appointed. I'm being cynical, but I really think that's the fact. So the Fed is a very collegiate body. Now, in my view, I'm thinking of the Fed members as human beings, right? So one guy here will say, I really think we ought to be careful cutting rates because look at the inflation numbers. We haven't conquered inflation yet. I think we should hold rates steady. But okay, Powell, you want to cut them, I'll go along with you. Now, when Trump parachutes in his own person and already has one person on the board, I'm going to be much more willing to dissent. I think. So it's very clear from looking at the minutes of the Fed over the last 6-9 months, but the Fed is fairly divided. There are those who really are most concerned about inflation and want to resist cutting and even raise rates. But again, they haven't dissented. But when you've got a Trump appointee parachuted in, I don't know. I think that gives people sort of license to dissent.
Well, I think that human angle is pretty important, and I don't think a lot of people talk about it. I think people tend to think of them as, just different inputs. But yeah, the human angle, yeah, it gives us an idea of how it could play out.
Yeah. Well, I mean, I know it's true in things. I won't talk about it, but you're on an investment committee, and you have a debate about should you buy NVIDIA or should you sell it, and in the end, it's 3 against 4, but the chairman says we'll hold. Okay, everybody says hold. But if some guy outside comes and parachutes someone in, I'm going to be much more vocal about what I think.
Yeah, I think that is human nature. The other thing I wanted to bring up, I don't think that we covered this last time, but in the stock market, there's this growing AI concerns that have been developing this past week, and even back beyond that, people are getting more worried about this sector. I wonder if you could talk about your thoughts on that. How do you see it playing out and the impact, again, on hard assets, gold?
Yeah, well, I'm not a technology expert, but I do know. I think I know a little bit about human nature, and when you look at technology generally, one thing to understand from technology is that it becomes more efficient and smaller. So you can do more, and with a smaller size. You only have to think of the iPhone and the computing power we have on the iPhone, but think of other things as well, over the past. And so when we have all these projections from companies for 4 million square acre data farms, I think the projections are just driving us towards massive overbuilding. And within 5 years, that is by the time some of these are actually built and ready to go, within 5 years, we'll be able to do a lot more with a lot less, and we simply won't be needing all of the data farms that are being projected. The other thing I find really interesting about this is you've got companies like, let me back off. A really successful tech company like Amazon, they lose money for years and years and years as they're building up their infrastructure. But then they reach a certain point where they don't need a lot more in terms of assets. Meta might be an even better one, where it's really very, very asset light, right? It's an asset light business. And that's been the sort of drive, if you like, of a lot of the new technology is to have an asset-light business. Maybe you need to have an infrastructure to begin with, but you don't continue to expand your infrastructure. You try to run a business asset-light. The interesting thing about this is that companies that are asset-light, like Meta, are now completely reversing and putting 3/4 or even 80% of their cash flow into infrastructure. And I think it's going to end in pain for a lot of these companies, frankly. For that reason, but also for the reason I mentioned. I just don't think we're going to need all this stuff.
That is also.
And we don't. I'm sorry to interrupt.
No, go.
And we don't have the power or the copper to build these things and to run these things.
Right. So we're not even prepared to have them anyway.
Exactly. Sorry to interrupt, but yes.
No, of course. So, yeah, this is all really interesting. And so there's this idea that maybe people will rotate away from tech toward commodities. But also, when we were in Vancouver for VRIC, I heard a lot of people talking about rotating out of precious metals where maybe they've made some profits into other areas of the resource sector. And I wanted to get your thoughts on that as well, because you've been very adamant in telling us that this run in gold is not over.
Yeah, no, I absolutely, very firmly believe that the run in gold is not over, and that if it's not over, the gold stocks generally remain very, very inexpensive. So you look at a company like Agnico, which I probably mentioned last time, but you look at Agnico, price to cash flow, price to free cash flow, which is my favorite metric for a gold miner. Price to free cash flow today is higher than it was at the end a year ago, at the end of 2024, but it's lower today than it was in 23, 22, 21, 20, 19, 18. In other words, for the 5 years previous, it was trading at a higher multiple than it is today. That just doesn't make sense if you think the gold price is going up and you think look at the margins. I mean, the margins are astonishing. Agnico's all-in sustaining costs are under 2,000. They're what, 1,850 or something? I mean, just think of the margins that these companies have. So unless you think gold is going to collapse, I think, which I don't, I think the gold stocks are inexpensive as well. But having said that, if you look at, and this actually is what I talked about at VRIC, so it's interesting you're asking me now.
I didn't see your presentation there, so that's my fault.
But if you look at, I mean, gold obviously has well outperformed copper, even though copper's at an all-time high. But then when you come to things like oil, uranium, agriculture, I mean, gold has just left those in the dust. Gold and silver have left those in the dust. You look at the commodity complex generally, like the Bloomberg Commodity Index, for example, and all of these commodity indexes, they rebalance at the end of a year or at the end of a quarter, but Bloomberg at the end of a year, so that gold and silver's big run-up gets, the percentage in the index gets reallocated. All of these commodity indices are basically at 100-year lows relative to the stock market. 100-year lows. Gold and silver are small potatoes. Copper's not, but gold and silver are pretty small in the whole commodity complex. So no, the commodities remain incredibly undervalued relative to financial assets. The commodity stocks, the same thing. Commodity equities. 100-year lows relative to the broad stock market, and obviously gold has done much better than the other commodities over the last year, 2, and 3. So the question is, does it make sense to trim some of your gold holdings if you've been in the market a while to buy other things? I think it does, but I would say that for me, gold remains very undervalued. But not only that, it remains on a risk-reward basis. On a risk-reward basis, it still remains the best asset. Because if you look at whether it's copper or zinc or anything else, there are risks in those commodities that we don't have in gold. If the global economy slows dramatically and moves into a recession, doesn't matter what's happening with AI farms because, they're going to be cut back in a recession. The resources will be hurt. So gold has a better risk-reward profile. And if I may, yes, we're buying. So a lot for us depends on the client. If we get a new client, here's X amount of money for a resource account, we are still overwhelmingly emphasizing gold. Now, of course, if you buy Franco-Nevada, you're buying 20% oil and gas. If you buy Barrick, you're buying 25% copper, etc. But we're overwhelmingly emphasizing gold because it's a better risk-reward. But if we've got I nearly said a guy, if we've got a esteemed client that we've had for 20 years, and, the gold has moved up to maybe 40% of their portfolio, even though I've been trimming it along the way, well, I'm not going to add to that. I'm going to be buying, other things instead. The other thing, if I may, it's not just commodities. I mean, if you look at the broad market, we're seeing a rotation. You mentioned rotation. We're seeing rotation out of the big tech, which has driven the U.S. stock market for the last 5 or 7 years, and AI for the last 4 or 5 years. But big tech has really driven the U.S. market, and it's beginning to roll over. And last year, the global markets, that is the foreign markets, the world ex-US, outperformed the S&P by almost 2 to 1. So the world ex-US was up like 32%, the S&P was up like 17%. It's almost 2 to 1. This year, if you look, same thing's happening. All of the all of the major global markets, I should say, all of the global markets are outperforming the US by a meaningful amount this year. So I think we're already seeing that rotation out of the US into foreign markets. We're seeing that. We're also beginning to see, to a lesser degree, a move out of big tech towards things like out of growth towards value, out of big cap towards small cap, and out of, big growth companies, speculative growth companies, to more defensive companies. So we're already seeing these shifts.
It's a lot of rotations going on right now.
Absolutely.
One follow-up question. For that larger client who has a lot of gold exposure, they need to trim it back and put that money somewhere else. Where in the resource sector would you look? Would it be toward copper? Or?
Well, I'm exceptionally bullish on copper. So even though copper's at all-time highs and the copper stocks have generally done well, I remain very, very bullish on copper on a 5-year basis. And I know we've talked about this before, but the beautiful thing from an analyst point of view about copper is it takes so long to get a project, not just from exploration to a resource. Forget about that. That can be 80 years. But from the time you have a resource to the time of production, we might be talking 15 years or more. And even if you have, a fully developed project, I think I may have mentioned this to you not before, but I was talking with Richard Atkinson once. He's a chairman emeritus, I think, but he was the CEO of Freeport. And I was asking why they weren't, with everything bullish he was saying about copper, this was 5 years ago, with everything bullish you're saying about copper, why aren't you developing more mines? Anyway, but in the context of that answer, he said, we've got projects that are shovel ready. We've got permits, they're shovel ready. He said, if the board of directors gave approval tomorrow morning, it will be 5 years minimum before they started to produce. And so when you think about that long time frame, we have very, very good exposure to what copper production in 5 years is going to be. It's highly, highly unlikely that there will be a major source of copper production in 5 years' time that we don't already know about and haven't accounted for in our models. Some mines might do better than we expected. Most will do worse than we expected. But there's not going to be a big source we don't know about. And so the conclusion from that is that if you look at optimistic estimates for production in 5 years' time, and you look at conservative estimates for demand in 5 years' time, there remains a mismatch. And that mismatch, a deficit, there's no such thing as a deficit in metals because the deficit is resolved by higher prices. So we're going to have higher prices. So copper I'm very bullish on. Oil and gas is a tricky one because the oil stocks, forget about today, but the oil stocks have actually moved up over the last 3-4 months. Maybe a lot of people have been listening to Rick Rule. But the oil stocks have moved up fairly significantly and way ahead of any increase in the oil price. Nothing to do with Iran, nothing to do with this weekend. So when I look at the oil stocks, I'm finding it, frankly, in the last month or two, I've been finding it difficult to actually find companies I want to buy at the prices that they're on offer. So at this point, I would look for a pullback before jumping in. And the big global integrators like Exxon and Chevron, I think they're pretty fully priced. I really do. But we're looking at some of the big independent E&P companies, like EOG, for example, the former Enron Oil and Gas, the only part of Enron which actually was a big success. But EOG is a great company, and there's others like that. Some Canadian companies, Canadian Natural Resource we're buying, or have been buying, sorry, we're not buying now. And then, agriculture generally, I think, is very inexpensive now. It's a little more difficult to know how to buy agriculture, but some of the potash companies are good. the phosphate. I tend to get agriculture through, well, a company like Altius, for example. Again, I'm not buying it now, sorry, but it's one of our largest positions. Altius is a great company, and that's a royalty company. So a bit lower risk than the actual producers. But they have it's not an agricultural company, but they have high exposure to agricultural commodities. So it's a good way of getting that exposure.
Well, I'm glad you mentioned agriculture. We always ask people before these events if they have questions, and one person told me, stop talking so much about gold and silver. Talk about agriculture.
Really?
Yes, so there you go. We did
Well,
that.
agriculture is very difficult for a lot of reasons. And again, I don't pretend to be an absolute expert on that. But I mean, obviously, if you're looking at the crops, then the weather is a huge factor, particularly for things like wheat and soybeans and so on. Less so for some things like, pistachios and almonds and so on. But they still need water, so water becomes a big issue. If you're in California with an almond farm, well, did you have a lot of snow? And so will you be getting water? Are the reservoirs full? Will you be getting water for the planting season, growing season? So those are big factors, and that can vary from, obviously, the weather and the rainfall. The water availability varies from year to year. And so it's difficult to say, oh, yeah, I think you've got to buy pistachio farms, and then in a year's time,
Yeah, that gets very complicated
Yeah.
very quickly.
There are companies. There's a company we own quite a bit of. Again, I'm really sorry, we're not buying it now. But it's called Glass and Land. So Glass and Land that's a company that buy farms and lease them back to the farmers. So they don't do the actual farming, except on a couple of farms where the farmer retired. But basically, their model is you lease it back to the farmer, who's the expert, but you own the farm and you get a percentage of the crop. And so and it's all in the U.S. So that's a good way to get exposure to agriculture, I think. Most of their crops are perennials. They don't do many of the annual crops. Most of them are in the western United States, so water is a big issue, although it's obviously something they're fully aware of, and they have bought water reservoirs and water pipelines. So that's a way of getting exposure to agriculture.
That's really interesting. Those are ones that I didn't know about, so very
Right.
helpful. I will let you go. I'll send you back out onto the show floor. I know
Thank
it's
you.
such a busy day. Unless you had any final thoughts.
I think the final thought I would have is, we talked about the new client, and we talked about the long-established, esteemed client, and so on. I think the final thought would be, you have to, whatever you hear about, whether it's me talking or it's on your show, whatever you hear about that sounds interesting, you've still got to tailor that to your own portfolio. And, you don't want to go overboard on any particular thing. You've got to right size, but you've got to do it according to your circumstances, your risk preference, et cetera, et cetera.
I think that's a good note to end on, important for everyone to remember. So thank you so much for spending the time today. This was really helpful.
Well, thank you so much. Appreciate it, as always.
And once again, I'm Charlotte McLeod with investingnews.com, and this is Adrian Day of Adrian Day Asset Management.